Vice President at the Federal Reserve Bank of New York, which means that everything I'll say here is subject to the usual disclaimer. Just a couple of words how we organize these sessions so that you know what to expect. So we put together here a panel of three speakers. We'll start with Diana Hancock, who is a Senior Associate Director at the Federal Reserve Board. Then we'll have Nicola Cetorelli, who is a Vice President at the Federal Reserve Bank of New York. And lastly, we'll have Alan Berger, who is the Caroline Distinguished Professor of Banking and Finance at the Darla Moore School of Business at the University of South Carolina. And so the plan or the arrangement or the agreement we made was that each one is going to talk about one different topic. Diane is going to focus to climate, Nicola on shadow banking, and Alan on the banking transmission, broadly speaking, mechanisms. And the key idea that I asked them was to come up with a brief description of where the literature is in these areas, but most importantly, give some suggestions of ideas or questions that are in need of research that you could take advantage in your PhD program. So with that in mind, let me move to the first speaker, who is Diana.
Thank you. Can everyone hear me?
Yes.
Terrific. This is subject to the usual disclaimer, but I'm really happy to be here today. And I put on this first slide a link to a Fed's note with the same title and the same picture. And if you're more interested in the Fed's framework for looking at financial stability, please go there. So can we go to the next slide? So economic and financial risks can amplify each other. And for climate risks, they can, we usually refer to them as looking at increased frequency and severity of natural disasters, such as rising sea level, greater temperature volatility. Those risks can affect both risk to economic activity, which was the first paper in the session earlier today, or they can affect financial risks directly. So examples of changes in economic activity might be changes in employment, service provision. Changes in financial risks could be changes in the values of financial assets, the cost or availability of liquidity or credit, access to risk mitigation instruments, such as insurance policies or operational losses. So let's go to the next page. So we typically think of climate transmission as starting on the left side of the box that we have here. And the physical risks might be acute climate hazards or chronic climate shifts. And transition risks could be things like changes in climate policies, such as a carbon tax, technological advances, such as new ways to capture carbon, and also big shifts in investor and consumer perceptions. So consumers, for example, can start thinking, I really want to have an e-car instead of an internal combustion engine. Those kinds of risks kind of translate into the second group that's in the gray boxes. So that can have nonlinear impacts on financial risks and models. It can result in timing uncertainty or incomplete contracts. And a lot of these exposures currently, there's a great opacity about those exposures. Who's holding the risk? As a result, that leads to various vulnerabilities in the financial system with respect to asset valuations, borrowing by businesses and households. It can affect leverage in the financial sector and funding risks. Turning to the next slide. I thought it would be useful to kind of think of some transmission channels on a more kind of substantial basis. So, for example, with real estate, you might have rising sea levels or greater frequency of storm surges. That could result in increased inundation of coastal real estate. That could result in decreased value of coastal real estate values. And on the financial stability risks, it might be that those mortgages for those properties are in mortgage-backed securities, and you could have abrupt repricing of those mortgage lending markets. Another example is insurance. The climate risk might be more frequent or severe hurricanes or wildfires. That leads to greater disruption to local economic activity. Then that can result in pressure for higher rates or a lower supply of insurance, or the difficulties associated with reinsurance. And then that can result in perhaps greater uninsured losses. So for example, if it's super, super expensive to get insurance coverage on your house in an kind of wildfire area, you may not insure it. And then when you have a wildfire, that can result in a lot of uninsured losses and spillover effects. Turning to the next page, I thought it would be useful to think about some of the challenges associated with assessing these climate-related risks. So first is the availability of sufficiently granular, spatial, temporal, and climate-related financial data. We have just started at the Federal Reserve to try and gather information on weather information. And depending on the time period you look at, sometimes you have to use satellite imagery and things like that in order to get it down to the area that you're looking at. You go further back in time, you're relying on weather type gauges and things like that are largely on land. So trying to get that sufficiently granular information, even on something like weather, is actually quite intense. Climate models typically simulate the interaction of a wide range of variables over many decades. And so it's very difficult because climate change and its impacts on economic activity may be very local or regional. And trying to build that into the models and kind of thinking about the US, it could be one area is subject to one kind of climate risk, say hurricanes in New Orleans, and another area is very subject to wildfire risk, such as Lake Tahoe in California. Other modeling challenges include the various ways that mitigation will occur and how that'll affect the physical effects of climate change, or the lack of mitigation and how it will affect climate change. You might have heard about ESG scores that are available from companies such as Moody's and S&P. And it's really interesting because each of the vendors has a very different methodology for developing these scores for individual firms. And just yesterday, the Wall Street Journal was looking at 1,500 companies in 3 different firms, and they found that 2/3, 942 of the companies, got different grades from the different raters. And part of that is because some of the raters are focusing on E, which is what we would be interested in for climate change, whereas others are looking more at a higher weight on governance and such. So, and they were looking at Refinitiv, MSCI, and Sustainalytics for their experiment. Turning to the next page, I have 4 key research questions. So my first one is, do asset prices incorporate climate risks? And here I have Kiwa Island and the prices of real estate and how much flooding is available according to Realtor.com. You can see that the houses that are most likely to be underwater have the highest price. The second question is, are insurance markets robust enough? And if not, how will this affect government risks? So the backstory on that is Florida has a lot of hurricanes. So they've taken on a lot of the flood insurance in California because private providers were charging a lot of money for it. But of course, the likelihood of hurricanes and floods seems to have risen. So how is that going to affect the state government? The third question is kind of market-based effects. So when we think about credit default swaps, cat bonds, securitization markets, are those kinds of markets reflecting climate-related risks? And how far are they looking forward? And the last question is, are models of systemic risk capturing climate risks? And I would point out that climate risk is really something that's more existential than most risks that only impact one place. Climate risk, because of the warming of the planet, can affect different places differently, but all of them at the same time and with increasing frequency and duration. So those were my key research questions and a little background, and I'll turn it over to Joao.
Great, thanks, Diana, excellent. And for those of you that are interested, this United Nations just published its most recent report on climate change, which is very comprehensive and of course global in nature. One thing I forgot to mention, if you have questions, I hope you can, and please post them on chat, and when we end the presentations, we should have time for trying to answer those questions. On that note, let me pass the baton to Nicola.
Joao, thank you. So the broad topic that I wanted to cover was non-bank financial intermediation. We don't call it shadow banking any longer, Joao. We now call it non-bank financial intermediation. But joke aside, the point that I wanted to make is that really you cannot think or talk about financial intermediation without acknowledging the role that non-banks have played, and it's unquestionable that financial intermediation services have been increasingly, steadily provided by non-banks over the decades. This is a phenomenon that has been observed and analyzed for decades. I'm not even going to mention that to be like a salient point. It's just a fact. What I would like to point out, though, is, and I think that's what is interesting, is the way in which non-bank financial intermediation has evolved. And I think a way to put it is the following. Think of a bank as it is portrayed in a traditional way. One of the paper in the session on bank intermediation before started, I think it was Nishan paper, started with a slide that showed the balance sheet of a bank, a traditional balance sheet, deposit on one side, loans on the other side. And so I guess the point that I want to make is the evolution in financial intermediation that has been observed over the last 2-3 decades is not really about non-bank entities replacing banks, but using that kind of model intermediation. In other words, providing both the liquidity services that normally deposit contracts provide, while at the same time providing credit services. The way in which non-bank financial intermediation has evolved over the years is basically the result of a whole transformation in the technology of financial intermediation. And I think that's the point that I want to make, and I'm trying to say a few more words about that. Probably the best example of such a transformation in the technology of financial intermediation would be in reference to asset securitization. With asset securitization basically in the early 1990s, we observe essentially that the traditional model of banking, the model of originate and hold, becomes somewhat obsolete. And I think the point that is important to make is that with asset securitization, you can now provide intermediation services while separating the provision of liquidity services and the provision of credit services. So that kind of model that is represented by the traditional balance sheet, as the one that we saw in the session earlier today, is not, again, necessary in order to provide those services. And so increasingly, we see, for example, open-ended mutual funds. There are major providers of liquidity services, I would say substituting for deposit or deposit-like contracts. You find other type of asset management entities that are specialized in the provision of credit. Think about the CLOs that were also discussed in another paper today. So important in as essentially supplier of corporate credit. In fact, there are some open-ended mutual funds that interestingly seem to be able to offer at the same time liquidity services and credit services at the same time. And this is a relatively new evolution in the asset management industry. And this would be open-ended bank loan funds. So these are essentially funds that at the same time provide liquidity services to their customers while holding shares, participation in syndicated loans. That is an interesting evolution. In fact, Joao and I are working on exactly on trying to understand the implication of having this type of entities involved in this type of markets. And so there are other examples, of course. Mortgage REITs are incredibly important for the supply of mortgages. CLOs, as I was mentioning before, they are very important in the provision of credit, but normally CLOs do not provide liquidity services. And so the point that I wanted to drive home here is that understanding that the importance of non-bank financial intermediaries is intimately linked to the process of evolution in the technology of intermediation, to me, is really a key insight, is the way in which I would recommend to approach trying to understand this new form of financial intermediation that we see prevalently in markets nowadays. It is a key insight, but I'm not sure it is one that is fully appreciated. I think it is quite fully appreciated and understood in policy circles, in central banks. Anyone that follows, the policy debate, I would probably be saying something quite boring and repetitive here. But I think on the research side, this would be a useful insight. And so, to me, that would be the first suggestion for a line of inquiry, somewhat innovative for anyone that would want to push the agenda in trying to understand financial intermediation dynamics. And it's really the how and the why alternative forms of intermediations emerge. So that's the first one that I would want to touch on. There is then a second item that is related to what I just said, and I think it touches on the connection between banks and non-bank financial intermediaries. How do they coexist? And to some extent, what happens, if one segment of the entire industry is growing more or less, how does that affect the growth of the other side? And so there is an intriguing point. I mean, it is intriguing to me. Maybe my colleagues here find that obvious. I'd like to hear perhaps their opinion on that. The point that I find intriguing that, and everybody on this call know that financial intermediation is intrinsically a fragile activity. By definition of financial intermediation, I don't have to explain why that is. And so if you think of banking has been subject to crisis for centuries, no? Until we invented, I'm using the quotes, the lender of last resort function. And then until many decades later, many countries, many economies formalize the concept of a taxpayer-backed, form of liquidity guarantees. I'm talking about deposit insurance specifically. And so there are no explicit guarantees for non-bank financial intermediaries. So the question is, how is it that non-bank intermediaries can thrive if fundamentally the services that they provide are so potentially subject to instability? Why would you want to put money into, again, a vehicle that could be exposed to major, run risk, for example? And so I think that is an important question. I think prior to the other financial crisis, the one in 2007, 2008, one point that became quite clear, and I don't have the time to elaborate on that, it was actually that banking institutions were the private backers of shadow banking. And so to a large extent, what made possible for non-bank financial intermediation to grow over the 1990s and the 2000s was essentially due to a banking institution providing some form of implicit or explicit form of support to shadow banking. Now, bank regulation has caught up with that, after the financial crisis, but we still observe, and so that kind of backing is not actually that obvious to me that can be provided, but nevertheless, we do observe in non-bank financial intermediation to be doing just well. So exactly how is that supported? So maybe it's an issue of implicit guarantees that investors believe that the government, in any case, is behind in providing support to these vehicles if something goes wrong. One may argue that what we observed 16, 17 months ago could be another piece of evidence in support of that, but I'm not going to push that argument so much. But I think that is it is an intriguing point. How is it that banks and non-banks evolve together? And so I just mentioned regulation, which takes me to another potentially interesting line of inquiry, which is what is the role of regulation? And usually when I say the role of regulation, I'm talking about bank regulation. How does that affect the evolution of non-bank intermediaries? After all, regulation is itself an element that determines the evolution of the technology of financial intermediation, right? So you can think that to be one of the main factors behind that. And so, I mean, the obvious point is that you constrain banks in what they can do, and the activity that they were doing, moves, in areas where the regulation is lax. There is a very recent paper by Irani and co-authors that that was published on the RFS last year that makes exactly that point. But there are other papers as well that have sort of discussed that part. And by the way, I have put together a quick a sort of literature on this. Maybe I will share it in the chat at the end of my remarks. But I want to go back. So this is another area to me that is very, very important. It's not just important for policy institutions to understand the role of regulation, but I think it's central also for academic work in and of itself. So let me perhaps end with one more line of potentially interesting inquiry. Which goes back to the joint evolution of banks and non-banks. And so it is the case that you can think of banks and non-banks as basically being substitute. In other words, that it's either or if you want to receive, for example, liquidity services or maybe credit services. But there is also an interesting element related to the possibility that, in fact, there may be complementarities across different type of entities that provide certain type of specialized financial intermediation services. And so, for example, just to try to put it into practical terms, could we think that, in fact, having a traditional banking institution, a deposit-taking institution, would benefit? Would there be benefits if this banking institution, operated together with an asset management arm, or whether it would have, a control from an organizational perspective of specialty lenders or broker dealers, and so forth and so on. So the existence of these complementarities, of these potential synergies across different type of entities that could be providers of financial intermediation leads to an interesting point, which is that banking institutions themselves are likely to change and to adapt to the evolving model of financial intermediation. And so if it is the case that these synergies are present, it is possible that we should be observing, the prediction is that we should be observing banks to increasingly perhaps acquire control of asset management companies, of insurance companies, broker dealers, and so forth and so on. And guess what? We do actually observe a ton of that. If one studies the evolution of the banking firm in the United States, it is exactly a story of adaptation and change, and it is one of the main factors that explain how bank holding companies have gone from being very simple, if you will, organizational structures to very complex organizational structures over the years. I have a paper on that that just got published this year. That I can suggest as another potential, sort of source of ideas. Joao, I think I have probably exhausted my time, so I'll stop here. And if there are questions, of course, happy to take those.
Thanks, Nicola. And let me remind people, so the please take advantage while you have these folks here, including myself. If you have questions, post them on chat. There is already one there, and the rule is first come, first serve until we exhaust the time. And on that one, let me move to Alan.
You have disabled me from sharing, so yeah, I need to be enabled. Somebody's disabled me.
That should be Kevin's role.
Kevin? Oh, okay. It looks okay now. Okay. All right. Do you see my screen now? Do you see it? Okay. All right. Very good. Okay. So I interpreted my my role here a little bit differently. I'm actually going to discuss one of the papers by Nishant that he presented earlier. But I'll do a little bit of discussion of that, but mostly I'm going to provide guidance on his topic, really, which is shocks in banking. And I'll provide some data sets that can be used and some questions and some ideas for that. So let's go ahead and proceed. Okay. It's not. All right, here we go. All right. So this is a really good paper, and I have to say I'm very impressed with Nishant's paper and all the other ones, by the PhD students. These are really very advanced papers, so very, very good. So the paper has a lot of good ideas. Deposits are crucial to lending, which in turn supports the real economy. It's not a new idea, but it's a very good idea. And Nishant and his co-authors call that the liquidity transformation function, under which banks provide liquidity to the economy by funding illiquid assets like small business loans with liquid liabilities like transaction deposits. As I'll discuss later, actually, this function is more general than that. It goes way back in time, and it's usually called by a different name, and we'll get to that momentarily. So as discussed in the paper, local supply of deposits is subject to strong shocks from natural disasters, from wildfires, from hurricanes, things like that, and as well as resource discoveries that leads to widespread lending shocks that create economic fluctuations. And of course, that's not new either, and we know that. And of course, some of these papers got brought up, like Eric Gilgy and Phil Strawn's papers, and the authors do a good job in citing that whole literature. So that's very good. So what's the new idea here? Hey, when deposits are locally concentrated, like everybody's in, all your deposits are in New Orleans or something, the risks to the real economy are quite a bit greater because the exogenous shock to the deposits there are going to create aggregate variations in lending output. And they show in the paper that it's really quite large. This is a genius idea. It's really good. They show it's theoretically important and empirically it's quite well documented. So it's very good. I like the theme of the paper of using exogenous shocks in banking research, particularly when it comes to the effects on the real economy. And I would be remiss if I didn't point out there's actually a whole special issue of the Journal of Corporate Finance on this that I edited last year. And I have a lead article on that you can check out if you'd be interested. All right, so what am I going to do? What am I going to talk about? So my main goal is to provide some guidance about this type of research on shocks in banking. For the young scholars, but maybe old scholars can get something out of it too. I'm not sure. We'll see. So I'll have kind of 4 points I'll cover. I'll do this very quickly now. You need to make sure you always cite the earlier research on similar shocks. And we'll talk about monetary policy research had this shock in here about deposits affecting loans affecting the real economy. So we need to do that. We need to be very careful about direction of causation. Anjan already brought up this point that not only goes from deposit to loans, but loans to deposits. And by the way, there's something in banking that's enormous called off-balance sheet activities, like loan commitments. They're actually a big part of what banks do. And then one possible solution to this problem of, one thing causes the other thing in banking is you combine all the products of the banks together. It works very nicely. It avoids the direction of causation, yields a better measure of bank output. And there's a measure of that that's available to all of us for free. And then finally, in future research, I'll point out, actually, we may not always be wanting to just look at what banks do, but actually about their managers. Banks do what their managers want them to do. So managers might respond to shocks, and I'll also show some free data on that as well. All right. So the first literature to link deposits to lending to the real economy, that was monetary policy. So traditionally, banks had no role in monetary policy. Monetary policy just lowered the interest rate, made people want to invest and consume more. Milton Friedman, who most of you know who that is, great economist, he actually said maybe banks shouldn't be allowed to lend because it interferes with monetary policy. So just get rid of that bank lend. That's not, we don't need that. We don't need that. And of course, the ISLM model that I learned back in college in the 70s, there are no banks in there. They just, monetary policy, banks invest more, businesses invest more, consumers consume more, interest rates are low. So we know today that those are, really outdated ideas. So we saw in the 1980s, bank credit got into monetary policy, and there was one channel for demand and one channel for credit supply. The credit supply channel is called the bank lending channel. So when the Federal Reserve sells securities, it decreases bank deposits, that chokes off the available lendable funds, and this has been shown to work. On the other side, it also can affect credit demand because if higher interest rates destroys the value of collateral, and there's plenty of research that shows this works also. So as obvious identification problem, you can't differentiate between credit demand and credit supply very well. And one way you can do it, there are a couple of ways to get around it. One is you can look at the loans made under commitment, because loans made under commitment, those are, the supply was already fixed beforehand. The commitments were made in advance, so you can look at that. I have a paper in the JPE on that, and Don Morgan has a paper in JMCB on that. Other identifications look at things like bank capital, affect credit supply, but not demand. All right, bottom line recommendations. What should we be doing? Always reference the original literature with your ideas, such as shocks to deposits affecting loans and real activities, and always be careful about identification, whether it's credit demand or credit supply. All right, next issue here. Now, are natural disaster shocks really pure deposit shocks to the financial system? As I said, Anjan already spilled the beans on that, and you can see his paper at the bottom of this slide here. We know that deposits don't just affect loans, but loans also affect deposits. So when a bank makes a loan, it creates a transactions deposit account, the full amount of the loan. So $1 of loans creates $1 of deposits. The borrower presumably doesn't just keep it there, they spend it, they hire a worker, or they make an investment or something, the money goes somewhere else. But that money also ends up in somebody else's bank account as a deposit. So, and then as I mentioned, this creation of deposit loans goes all the way back before we even had regular banks, when we had grain warehouses function as banks. And that's Anjan's paper in the JFE in 2018. So essentially, they issued claims on the grain, and those were deposits, essentially. All right. Now, also we need to think about there's synergies among deposits that are on the liability side of the bank balance sheet, loans on the asset side, and loan commitments, which, as I said, are also a very important thing that banks do, and they're off the balance sheet. So there's research that suggests loan commitments and loans are efficiently produced together because the commitments allow the borrowers to use the funds when they need them. Loans and deposits also go together well because the banks observe the deposit flows and they know whether to make a loan. And loan commitments and deposits also go together because of synergies in employing the same liquid assets. And these are all papers in top journals, as you can see, that have pointed out these things. So now, and deposit and off-balance sheet commitments also affect the real economy as well as loans do. So transaction deposits provide liquidity services, off-balance sheet commitments allow customers to expand their investments and so forth. So the bottom line here is, well, disasters affect demand for and supply of loans and loan commitments in ways that have nothing to do with deposits. So, when a hurricane hits New Orleans, the local businesses, they change their creditworthiness, their needs for loans and loan commitments, and the banks change their credit supplies, given their hits to their capital. So all of these things say this is really not pure deposit shocks affecting loans affecting the real economy. So we know that loans create deposits. There's synergies among deposits, loans, and loan commitments. Natural disasters affect all three of them, and all three affect the real economy. So I encourage the author of this paper and everybody else that's doing these natural disasters, let's reconsider whether these are really pure deposit shocks and they affect loans and real economy. Really, there's and we're going to see there's a better way to go in just a second here. So let's go to, so as I mentioned earlier, Nishant and his co-authors called the creation of loans from deposits a liquidity transformation function. But there's a more general concept that includes the deposits, loans, loan commitments, the whole thing that I recommend using when we're looking at the effects of shocks and other bank phenomena. What is that called? We know what that's called. That's called bank liquidity creation. It's a more general concept in this liquidity transformation function. It includes loans and other assets, deposits, other liabilities, loan commitments, other off-balance sheet activities. And the measure actually is weighted in a way that's designed to capture how banks create liquidity for the non-bank public, and has been shown to be the best overall measure of bank output. Goes all the way back to the Wealth of Nations, 1776, but it was a concept then, and now it's been measured in the Berger and Bauman paper in the RFS 2009. So it said, I have papers that show it's a better predictor of the real economy and bank assets. It's better predicts financial crisis than macro variables and financial variables. And it is measured from the US call reports and available for free on Chris Development's website, which is right there. All right, so I encourage, if you're going to look at these shocks and everything, you know, whether it's natural disasters, resource economy, COVID-19, whatever it is, why don't we just use liquidity creation? We don't have to worry about which causes which in there. And it's a better measure of something that affects the real economy and the financial system better. You don't have to worry about whether it's a deposit, a loan, it's just a banking shock. Just go with that. All right. And then my last point here is you know, bank managers actually affect what banks do also. So we could use a different concept. You know, what do bank managers want to do? Well, actually, what they want to do is they vary the amount in which they hoard liquidity. It's closely tied to the liquidity creation. It's not quite the same. It's a little bit different. And so when a bank is subject to a negative shock, the bank managers choose to hoard liquidity to ensure they're able to function better during adverse circumstances. Okay, so many measure bank liquidity in the literature, at least 10 or 15 of them, sometimes liquid asset ratios, but there's one that includes all bank sources and use of liquid funds, takes into account bank assets, liabilities, off-balance sheet activities, and you know it's actually formed from bank liquidity creation, but slightly different. It's in the Journal of Financial Intermediation. The main difference is they're almost the opposite of each other, but deposits actually affected in both positively. Deposits help the borrowers, help the public have access to liquidity, but it also creates liquidity for the banks to increase their liquid assets. So it's shown that banks do hoard more liquidity when faced with economic policy uncertainty. Managers also hoard more liquidity when their sentiment is negative. And this one is also available for free on my co-author Hugh Kim's website, which is there. So I encourage people to, you know, if you want to consider what bank managers are doing, their reaction to shocks, you could use this measure. So let me leave it at that. I hope you find it to be useful. I'll make the slides available. And actually, Nicola made a nice suggestion that I could actually just kind of put this in the chat, and then everybody could just download it. I didn't even think of that before, but why don't I'll do that while we're talking, and let me leave it at that. Okay. All right. Thank you very much.
Thanks, Alan. Before I pass the question, let me make two observations about some of the things you mentioned. because I've been very interested in this. One was, in fact, the observation that you made of the link of the causality. It goes from deposits to loans. And you also pointed out correctly that it goes the other way around. And one interesting, in fact, episode we observed at the beginning of the COVID, as many of you probably are aware, there was this huge wave of drawdowns on credit lines. And what was happening at the same time is that many of those firms that were drawing down were depositing the amounts of money with the bank. Now, granted, it did not happen all the time with the same bank, but that there was that synchronization going on. So that's—
And Joao, let me also point out that also happened in the global financial crisis. It happened in both of the crises.
Well, that brings me to the second one, which is, in fact, to the point of these synergies about deposit taking and credit line making. And I think it was Josh Panagi that first made this point, which is, well, that works well as long as the bank has deposit insurance and lending of last resort. Because if they don't, then what the bank experiences is a double run. When the bank is, when there is some uncertainty about the financial condition of the bank, borrowers have an incentive to accelerate drawdowns on their credit lines because otherwise they will become useless. And of course, depositors will have an incentive to run on the bank. So that's an interesting concept there of optimality that works well when the bank is in good shape, but it may not work well all the time.
I think it's not just deposit insurance, but it's also too big to fail protection, because I think
in general, yeah, but the point is that
large firms that drew down the loan commitments, they have more than the insured amount, but they know that Citicorp and Bank of America and JP Morgan Chase are too big to fail.
Yeah, but more generally is the point about those synergies can also be a source of problems. So
yes.
Anyway, there is a question here on the chat for Nicola. Let me read. I don't know if Nicola, you saw this. The question is, do you think the run risk instability in non-bank institutions is because investors have the option to redeem their funds at will? So it is mitigated in closed-end funds or CLOs, or is it due to how shocks propagate due to accounting rules? So book value accounting can make the system more stable. Or do you think these are two sides of the same coin? You're on mute.
I know. Sorry about that. I'm looking at the chat, but I don't see that question. So now I made a double mistake. I did not pay attention to what you said, Joao, and I could not find what the question was. So now I'm sorry, you have to repeat.
That will cost you another $5.
Yeah.
Do you think the run risk in non-bank institutions is because investors have the option to redeem their funds at will? Or is it due to how shocks propagate due to accounting rules? Or do you think these are two sides of the same coin?
So I don't know exactly what the reference to the accounting rule is.
Book value accounting or not? That's basically.
Yeah, no, I think fundamentally for you know, if we are talking about open-ended funds, for example, it is exactly the fact that you know, these investors, despite their equity holders in the fund, these are not debt contracts, but they do have the optionality of redeeming at will, on demand, right? And so that is what opens up, you know, by now a well-established, you know, result, which is the first mover advantage. You know, it's different, you know, from a contractual standpoint, but in terms conceptually, it's not that different from the first mover advantage that one observes for banks, and it's just the fact that by being the first to get your money out of a fund, you are, you know, before the fund experiences a change in the overall valuation, you are essentially imposing an externality on everybody else. So, you know, there is a coordination problem there. So I would say that's fundamentally what drives the the incentive to run in this institution. I don't think that the valuation of the portfolio, of the balance sheet is an important point. Even if I understand the point, if the balance sheet of these entities was not subject to mark to market, it was just book to book value. If there were changes in the fundamental of the vehicle, you would still have an economic change in the value of the vehicle itself. So I would say that you would still be observing the potential for a run risk. But fundamentally, I think it's just the story of redemption at will. If you were to eliminate that, the redemption at will, you would have no problem. Of course, if you do that, then these funds would not be providers of liquidity. There would be no liquidity transformation to speak of. And that's a trade-off, right? I mean, do we want these alternative investment vehicles, alternative to banks, to be providers of liquidity transformation services? I think that's a big question, right? From society's standpoint, you could argue that there are actually very good reasons why, again, open-ended funds should be providing those services. The economy requires those services, and somebody's providing them. That's good. To go back to Joao's point, 95% of the time, it's probably it's a good thing. When markets are well functioning and there is no stress, it's a win-win. The problem is what happens when there are stresses, and if there are no protections. Going back to the conversation of a moment ago, then everything gets potentially amplified.
Joao, may I make a couple of comments for Nicola or questions? One is a couple of things you brought up. I want to question. One is, about the banks, are protected and the non-bank financial intermediaries are not protected. Of course, we know that in the financial crisis, many non-bank, other than Lehman Brothers, a lot of other firms got protected. AIG got protected, Bear Stearns got protected, the reserve fund, whatever that was called, a lot of protected. So we have to take that with a grain of salt. And then the other thing is, at least from a theoretical viewpoint, it's not, you mentioned, banks are protected from risk by regulation and other firms. But in fact, at least from a theoretical viewpoint, when banks receive deposit insurance protection, too big to fail protection, that doesn't necessarily make them safer because they take actions to take on more risk. When we have deposit insurance, you hold lower capital. When you have access to the lender of last resort, you keep less liquidity because you can count on that. So whether it's true you're safe or not, I don't want to comment on, but I just, from a theoretical viewpoint, you need to, just kind of acknowledge those points if you don't mind, or see if you agree or disagree.
Should I answer, Joao, or? Yeah, no, Alan, both points are absolutely right on target. The first one I thought that I alluded to. I mean, I was being a little facetious, and I have forgotten to mention that whatever I was saying was only my own remarks and not the one of the institution that I belong to. But you're absolutely right? I was being provocative in saying that non-bank financial institutions do not have access to some form of taxpayer backing. What we observed, I think I mentioned that, what happened in COVID crisis in March of last year was a second point and a second observation that in fact showed that there was a lot of explicit backing.
By the way, the guy that cuts my hair, he got a PPP loan. So yeah, he was too important to fail.
No, absolutely. And that in and of itself is a huge area of analysis that again, I don't know. Some of you guys are editors of journals. You can probably appreciate better than I can whether this is hot topics for publications in top academic journals. But that is literally the central question for regulators, right? And so I totally acknowledge that. On your second point, yes, that I have nothing to object to what you just said, and there is always obviously an endogenous adaptation. Whatever regulatory constraints you impose on me, I'm going to put myself on the frontier of the risk return. That's it's an inescapable fact. I think I would maybe just make a distinction between risk of the individual institution and financial stability implications. So it is still the case that an individual bank may be pushing the frontier, taking additional risk, exposing itself to potential default, distress, whatever you want to call it. But nevertheless, if the LOLR / deposit guarantee system, and let me mention the third leg, proper monitoring and oversight, right? If all that works the way it should work, then the system can accommodate the resolution of a firm that takes too much risk without imposing the financial stability externality to the system, right? And we just don't have the luxury of that for non-bank institutions.
So let me, since we are right on time, let me close with two observations. One on the Alan. Alan, yes, you are right, but it's still useful. Don't forget that there is the difference between ex ante and exposed. We don't want to put probability one that's all the guarantees will always be there and all the facilities will always be there. And there is a big difference between one and the other. So just one minor observation. The other observation I would make, which I think it's important for the students, as you probably recognize from this conversation, the three topics here at discussion have one big difference, which is the amount of research that has already been done. Certainly climate is the novel kid in the block. This is a brand new area. It's a new field, lots of new data, lots of new questions, lots of new opportunities. There's very little research on that. Shadow banking probably comes in between. I still call it shadow banking. Sorry, Nicola. And certainly the banking channels in many ways that they have been framed and coded or rephrased. It's a big literature, even though it's evolving, and Alan has made that clear, because banks are also evolving and they are changing, and the way one has to look at that has to be with fresh eyes and also new data and new techniques. So keep those in mind, because I think at the end of the day, you also want to do novel research or things that it's easier to publish and that you can make a mark and finish your PhD. And on that note, I want to thank Diana, Nicola, and Alan for these excellent contributions. I hope we have helped those who stayed with us for an hour, and best of luck for your PhD program. And I'm sure if you have questions or anything you think either one of us can be of any help, but don't hesitate to shoot an email, and we will we'll try.
So I could not figure out how to add my slides to the chat. So if you email me, I'll just send it to you. I don't know how else to do it. And can I add one other thing about research, which something we really should be saying here, which is that COVID-19 is still pretty new, and the journals love that kind of new crisis stuff. And so I would recommend for the students, if you have a topic on that, please consider pursuing that, because there's plenty of government programs and so forth. So if I had like one choice to do, that probably would have been my presentation. I would have told you to do the COVID-19 research, but I was, you know, I decided to go on the shocks instead. But I think that is your best bet right now, is to do COVID-19 research.
Well, on that one, hope everyone stays safe and enjoy the rest of the summer, and good luck with your research. Thanks.
Thank you, Joao. Thank you, everyone.
Bye-bye. Thanks, everybody.
Seeing you guys.
Thanks to the University of Texas for hosting us. Appreciate it. Thank you very much.
Thanks.